welcome everybody to this second research seminar of this term. And today we have a very interesting topic, as you can see, and people who are on our network knows that we had a conference back to September last year. So we gathered many experts on this topic or in this area. So either people are taking different research methodologies, either quantitative or qualitative, but we had a very intensive 2 days discussion about China's interaction in Africa. And this is the work built on, everything that we have done in this area. And today we have Jeffrey, who is our postdoc of Center for Global Finance, to present this paper. And this is a teamwork, and as you can imagine. And Jeffrey is actually with us, at SOAS for many years already. Jeffrey has done his PhD on the banking sector, with supervised by Professor Victor Murinde and Dr. Tulu in the same department. So since last April, Jeffrey switched to this topic. Since then, he has been working on this on China's infrastructure investment globally. So I think Jeffrey has been making quite a lot of progress for a new topic, and has digged, well, I do not know how deep, but has digged the literatures, etc., etc. So I hope people who are interested in this topic will be very interested in knowing what is going on here. So we know a lot about this topic already, but the new thing is now we are making the connection between host country sovereign risk with China's infrastructure investment. And moreover, this is a cross-section analysis, although panel data, but a cross-section units contain 110 host countries. So basically, we started with all the host countries, and then depending on the availability of the data, so now this is the product. So I will give the floor to Jeffrey, and Jeffrey, you will have about 40 to 45 minutes to present, and then we will open the floor for some much needed discussion, so that we can move forward in revising this paper, and then we can finish at least for the first stage. So Jeffrey, are you ready?
Yes.
So the floor is yours.
Okay, thank you, Hung, for your kind introduction. And thank you everyone for joining us. The work that I'm about to share with you, like Professor Bo just said, it's a joint work with her and Professor Victor Murinde. The topic that we focus on is the sovereign risk of host nations. We hope that the comments we get today will be able to help us to revise the paper and target the right journal, like Professor Bo highlighted. So this is the order that we present the work. I will introduce the topic, then the background on Chinese overseas investment the literature review, the data, the model, then the summary of our findings. Now, China has become an essential source of foreign investment for many countries, particularly African and Southeast Asian nations, because over the past 20 years, especially since 2013, when the Chinese government launched the Belt and Road Initiative, the Chinese overseas investment has grown significantly. By 2020, when the pandemic started, the overall global investment had increased almost threefold from what it was in 2013 when it first started. And by 2021, over 140 countries had signed agreement with China to be part of the initiative and work with China on infrastructure investments. Now, the reason that the Chinese global investment expansion has been hugely successful is quite simple. On the one hand, China invests in infrastructure development, which the host countries are desperately in need of, because most of the participating countries are developing countries with significant infrastructure shortages in their economy. And on the other hand, the initiative enables China to access new markets and natural resources to support its growing local economy. In other words, it's a win-win situation for both China and the host countries. But despite these benefits and several others identified in the literature, including higher employment and productivity in the host nations, as well as increase in competitive positions of both China and the host countries, the China overseas investment level has fallen since the pandemic. And this is the focus of our study. We investigate this from the perspective of the host country sovereign risk. The way that countries attract Chinese investment is different from the standard requirements within the so-called Washington Consensus that multinational enterprises from Western nations tend to follow, such as having sound institutional environment, being a democracy, or having independent media system within the country. For Chinese investment, as a matter of fact, there are no set of reinvestment conditions that the host countries must satisfy before approaching China to discuss investment. The approach that Chinese government seem to follow is case by case basis, but the government will engage with the host nation's government to develop trust, which is key, because there are no formal reinvestment conditions. So that relationship enables the government to build trust and understanding. Developing these ties with the host government can improve transparency and accountability. Now, we are going to look at the literature in the next slide, but Chinese firms have been shown to work more in weak institutional environment, that is, less bureaucratic system, which is interesting given that strong institutional requirement is one of the fundamental requirements when it comes to investors from developed countries. And when you look at it from this way, for governments in need of economic development, but cannot attract investment from Western multinational enterprises due to the strict requirements. The decision to approach China for investment becomes easier because they know what they are going to get from China, which is usually infrastructure development. And they also know what China wants from them, in many cases, natural resources. Of course, these countries are careful when making these investment decisions not to jeopardize their existing financial relationship with other foreign investors. We have to remember that most developing countries have existing loans and other financial arrangement with the World Bank, IMF, or the Paris Club. So they want to maintain that, but that does not mean that they won't consider other opportunities in their national interest, especially with Chinese investment model, which is more like a partnership and less costly. Well, a lot has been written about Chinese way of doing business in the media, including questions about the business model, whether it will lead to debt trap diplomacy or increase the number of developing countries that are depending on China economically. Well, these are legitimate questions considering the position of China in the global business environment, as well as the fact that China simply does not follow the foreign investment rules used by the Western nations. This study by Atkins et al. Wanted to provide some evidence on this matter. They tried to find out what it costs to participate and the obligations for the participating countries. They reviewed agreements signed by China and many host countries before investment projects started in their countries. They discovered that these agreements are simply memorandum of understanding with little or no obligations for the participating countries as well as China. Moreover, a recent paper by Professor Bo and Lawal, published in the British Accounting Review, shows no debt trap connection with these investments in Africa, which has always been one of the focus area when people are criticizing the Chinese way of doing business. Considering this background on the Chinese way of doing business, you can see why it is very popular among developing countries, especially those that would not receive foreign investment from Western multinational enterprises because of certain conditions that are difficult for them to meet under the so-called Washington Consensus. Okay. In this literature, it's very clear that initially researchers were not sure how to model China's overseas investment because the dominant assumption in this literature, the theoretical part of the literature, is that it's always been that internationalization of firms is motivated by their desire to exploit their ownership advantages in foreign markets, such as managerial skills, advanced technologies, and other competitive advantages that they may have. These advantages are defined in the context of developed countries in the original theory of FDI. Multinational enterprises from developed countries with this ownership exploit them in less developed countries, therefore not really applicable to foreign investors from emerging economy without these advantages, such as China. The most important question was how Chinese firms without obvious ownership advantages succeed in international market and compete with larger firms from industrialized countries, and especially being a latecomer in the international market. Well, that soon became clear that the booming Chinese internal market and government supports can actually provide some advantages for Chinese firms to engage in internationalization. Chinese firms receive direct support from their governments, especially low-cost capital. The government also provide direct support through policies that give incentives to invest in certain international markets, such as those with natural resources. This background helps to understand why, in the empirical side of the literature, government support is identified as one of the key drivers of internationalization of Chinese firms. And the Chinese government has managed to use these direct support and policies to influence where Chinese firms invest overseas. The government has encouraged investment in sources of natural resources through its support and ownership. The government policies are also driven market and strategic asset seeking of Chinese firms. But another interesting part of this literature or evidence on the way Chinese firms behave is the finding, which shows that there's high concentration of China's overseas investments in what you would describe as politically and institutionally fragile environments, suggesting that China is perhaps trying to avoid the higher level of bureaucracy associated with investment approval procedures in high institutional environment. Once again, this can be linked to the influence of government, because once a good working relationship is established between China and the host government, the institutional environment becomes secondary or irrelevant. Now, it is difficult to argue that any of the factors covered so far in this literature paper can help in explaining the declines in investment level observed since COVID-19. Moreover, this is the first time that investment level has dropped for a sustained period since 2013. Therefore, there are no studies looking into investment reduction in the literature. So we decided to look outside of the current literature to try and find out which government-related factors may have changed since 2020. The government focus here is important, since the Chinese investment is mainly influenced by the arrangement between Chinese government and the host government. So thinking in that direction, we quickly realized that global sovereign debt level reached a point that we have not seen before in 2023. The graph on the screen shows that the global public debt level has been rising since 2010, but crossed 75 trillion US dollars in 2020, and has been rising ever since. In 2023, this figure reached 97 trillion US dollar. So we try to match the literature, whether there's some papers going on that is related to today, when we look at some recent empirical studies on global public finances during the same period, impairment in sovereign credit worthiness have been commonly reported. Many cross-country studies show increase in sovereign risk since the pandemic. Now, combining these factors, it cannot be by chance that these two things are happening at the same time. There must be a causal relationship between Chinese global investment pattern and the deterioration in sovereign finances globally. The debt overhang theory provides a good explanation for this connection. When a nation is heavily indebted, it discourages new investment since income generated will largely go to the existing creditors. And this argument is supported by huge literature, which shows that higher public debt to GDP ratio increases sovereign risk. And sovereign risk reduces foreign investment inflows. With rising debt level, uncertainty over future economic policy rises too, and government becomes very cautious with their spending, knowing that additional expenditure may not lead to growth due to the high debt burden. We believe that China will be concerned about this level of global indebtedness and especially the uncertainty over future economic performance. We believe this is important right now because the number of troubled Chinese investment globally is growing. So it may be the case that there is a change in investment policy to focus on smaller and less risky projects moving forward. And we also know that for this to happen, China must be able to identify risky nations. However, we know that for this to happen, in terms of whether the investment really reflects the level of risk, China must be able to separate risky nation from non-risky nation. But this is not always easy to do, given that government level information is not easily accessible, which is why information asymmetry, as we see here, is one of the key barriers to cross-border investments. In countries with information asymmetries, foreign investors are always concerned about the lemons problem of financing bad projects. However, we believe that one of the reasons that government-to-government relationship is always part of China's foreign investment arrangement is to overcome this problem, to build understanding between the two countries. This relationship allows China to obtain important information to support its multinational enterprises investing in these countries. In addition to the information obtained through the ties between countries, sovereign risk ratings, which are regularly released by the third-party agencies, reflect all-round economic and financial risk information. And we now have ratings for almost all the countries in the world. Therefore, with these sources of information, we can assume that Chinese investment decisions are based on accurate information about sovereign risk, and the reduction that we have observed since COVID reflect the rise in sovereign risk globally. This argument leads us to our first hypothesis that countries with higher sovereign risk have received lower infrastructure investment from China, since COVID-19 than lower risk countries. Now, we know that China's overseas investment level has fallen, but that does not mean that China has stopped investing overseas. Therefore, the next question that we want to look into is why China may be investing more in some countries and other countries experiencing significant investment reduction. We investigate this by looking at the role of natural resources. One of the key findings that has remained the same in this literature over time is the resource-seeking motive of Chinese firms. Because the incentive to invest in sources of natural resources come from the government policies and supports. There is no evidence that this motive no longer drive Chinese investment. Therefore, we test the second hypothesis that since infrastructure investment are generally controlled by the Chinese government, and Chinese government-controlled firms are more likely to invest in sources of large natural resources, the negative effect of sovereign risk on China's infrastructure investment is weaker in resource-rich countries. The next factor that we consider is the role of geopolitics. Recently, a group of studies showed that there is a rising geopolitical fragmentation globally due to the tensions in the US-China trade relationship and the Russia-Ukraine war. And this fragmentation is changing the way that countries invest in each other. The evidence in this growing literature suggests that geopolitical alignment reduces the risk of foreign asset expropriation in the host country, and it enables foreign investors to gain important knowledge about the host countries through their national governments. As a result, investment are flowing more among geopolitically aligned countries. We believe that China will be considering this geopolitical fragmentation when it comes to making decisions regarding overseas infrastructure investment, which are usually long-term. In this literature, it is called investing in friends or friend sharing. We expect to see more infrastructure investment in countries that are geopolitically aligned with China, because such diplomatic relationship increases information sharing among allies and reduces the fear of losing their projects. So according to this argument, we propose a third hypothesis that geopolitical alignment reduces the negative effect of sovereign risk on China's overseas investment. Okay, to test these hypotheses, our dependent variable is the China's overseas infrastructure investment, which is in millions of dollars, US dollars. We obtained this data from the China Global Investment Tracker. We were able to collect the data for all the countries that have received infrastructure investment from China since 2013. However, few countries were not covered by any of the sovereign rating agencies, which provide our main independent variable. And these countries were excluded. Then we ended up with 110 countries in total. The sample period starts from 2013, when the Belt and Road Initiative was first launched. This is the graphical presentation of the dependent variable. It clearly displays a significant drop in 2020, as we can see, and there are no indications on the graph that improvement level, investment level has improved since 2020. The primary independent variable is the host country sovereign risk ratings. We obtain the foreign currency denominated long-term default ratings for the host countries from the top 3 global rating agencies, the Moody's, S&P, and Fitch. So to estimate the variable, we adopt a model that a method that is used in the literature, which transform the ratings into a numerical form, as shown in the table on the left side of the screen. We assign scores which range from 20 to 0. A score of 20 is assigned to a AAA rating, and 0 is assigned to a D rating. We then estimate the average score for each from the 3 ratings for each country. So the graph on the screen shows the annual average sovereign ratings for the host countries included in the study. And again, we can see a trend that has been falling for some time and is at its lowest in 2023. We include a number of control variables in the study. The GDP growth rate is included for the market-seeking motive of firms. Then natural resources rate to GDP for the resource-seeking motive, institutional quality, which is the average of the 6 governance indicators. We separate the trade openness to China from the trade openness to other countries because we want to maintain the belief that country-to-country relationship is more important to China. Then to control for information and transaction cost, we include a set of gravity framework variables, which account for common official language, common border, time difference, distance between host country and China. Here we have the summary of data. For the 2 main variables, you can see OII, which is the overseas infrastructure investment, has a mean value of 487.9, which represents an average infrastructure investment of $488 million US for the countries and period covered in the study. The average risk rating is 9.5, which indicates that credit risk is developing based on the scores that we generated in the ratings table that I showed earlier. Next to the data summary is the variance inflation factor, which is far from the benchmark value of 10. So we do not see any reason to worry about multicollinearity issue. This is the correlation matrix in terms of the relationship between variables. It looks good, just like the variance inflation factor. It does not appear to show any sign of multicollinearity issue. But what is important for us here as well is the fact that sovereign risk is positive in relation to OII, which support our argument that higher rating, which represent lower sovereign risk, and OII have positive relationship. Okay, we specify this difference in differences model, where OII is the log of China's overseas infrastructure investment, treated as a value of 1 if a country's average sovereign rating indicates the presence of sovereign risk limited margin safety, high default risk, bankruptcy, or default. Otherwise, it's 0. Post equals 1 for each year between 2020 and 2023. We include the control variables that I discussed earlier, then time and host country regional fixed effects. In terms of the estimation, this equation allows us to compare the difference in OII between high sovereign risk countries and low sovereign risk countries after the outbreak of COVID-19 with their pre-COVID levels. The beta in this equation reflects the treatment effect, and we expect this to be negative, meaning that countries in the treated group have received lower investment from China since COVID than those in the control group. Okay, this is the baseline results. The first variable here represents the treatment effect, which is negative and significant at the 5% level. This suggests that countries in the treated group, which are high sovereign risk countries, have received lower investment from China since COVID-19 than lower sovereign risk countries, which are those in the control group. We can also see that the variable post is negative and significant, which means that although high sovereign risk countries have received lower investment from China, investment overall has fallen post-COVID. And for the control variables, natural resources variable is positive and significant, suggesting that countries with natural resources attract more investment from China, and those which is consistent with the resource-seeking motive of Chinese firms that we discussed about in the literature section. The market-seeking argument is also supported by the data, as GDP growth rate is positive and significant. Institutional quality is negative and significant, which means higher level of governance reduces investment. Local infrastructure is positive, meaning that higher level of infrastructure attracts higher investment. Trade openness to China is positive, while trade openness to other countries is negative. This is why we wanted to split the trade openness variable to confirm that country-to-country bilateral trade relationship is more important to China than general trade openness, which increases competition. So, and quickly for the gravity variables, common language seems to have positive effects on infrastructure development, while in column 2, distance is negative and just significant at the 10% level. Okay, to test our second hypothesis that the negative effect of sovereign risk on OII, which we just discussed in the first table, is weaker in resource-rich host country. We classify country as a resource-rich if it derives at least 50% of exports from natural resources. The IMF set a baseline of 20% for this definition, but given that we have 91 developing countries in our sample, and developing countries rely more on exports of natural resources, we use 50% for this estimation. We run 2 DID regressions, one for the resource-rich countries and the other for non-resource-rich countries. If the DID interaction, which is the one that I highlighted, have a significant coefficient which is negative, that represents a meaningful effect of sovereign risk, while insignificant coefficients suggest otherwise. And you can see here that under the resource-rich countries, it is not significant. But when it comes to non-resource-rich countries, it's significant. This result suggests that natural resources mitigates the negative effects of sovereign risk on OII, which confirms our second hypothesis. But remember, this result represents sources of large natural resources, which is 50% of export or more, rather than just availability of natural resources. For our third hypothesis that geopolitical alignment mitigates the negative effect of sovereign risk on OII, we use the geopolitical distance or the ideal point distance between China and a host country, which is estimated using the degree of their voting similarity at the United Nations General Assembly. Countries' voting patterns at the UN General Assembly reveal their political preferences and alliances. Therefore, a high degree of voting similarity, which indicates an alliance, will result in a lower ideal point distance and higher alignment scores between two countries, while the similarity will give opposite indicators. Now, in terms of the result, similar to what we did under the natural resources, we estimated two DID regressions, one for the aligned group and one for non-aligned. And the treatment variable is not significant for the aligned group, but significant under the non-aligned group of countries. Again, this result suggests that geopolitical alignment does indeed mitigate the negative effect of sovereign risk on OII. China seems to invest more in its ally countries, suggesting that perhaps geopolitical alignment helps to address risk-related issues. Okay, now robustness. Having estimated all three hypotheses, we provide some robustness checks. We start with the propensity scores matching procedure. Now, by matching the control group with the treated group based on other economic factors, including GDP, we check whether treatment effect remains significant. So, but first we check whether our matching procedure is successful and accurate. So for this, we produce the graph you see on the screen. It shows that the plots of the propensity scores of the two groups, and they are very identical, similar on the basis of the variables that we have used in the matching procedure. So that means the two groups are identical. Then we do our regression based on that match sample. And the table on the right-hand side shows the result of that estimation. The ATT is negative and significant, which is similar to our results so far. It suggests that based on the matched sample, treated group receive lower investment than those in the control group, which are the low-risk countries. Okay, next we look at the parallel trends. What we need to check here is making sure that the treated and the control groups were identical before COVID. That is, the difference between the two groups pre-COVID is not significant. The method commonly used in recent papers is to estimate the mean difference of the two groups, that is, the total sample rather than the matched sample. And if the two groups were identical before COVID, based on on investment from China, the P value of the main difference should be insignificant. And the value that we have estimated here is 0.89, which means that the difference is insignificant and the groups were identical before COVID. This is also supported by the graph, which shows that until end of 2019, when the investment level experienced the huge drop, both groups were moving quite closely. So we can safely say that we have estimated our results based on comparable groups. Now, here we look at the margins of investments. It is possible that China has reduced the number of new investment in countries with higher sovereign risk without the size of average investment being affected, or simply reduce the size of average investment. For this estimation, the extensive margin is the log of number of new investment, while the intensive margin is the log of average new investment. The variable in both column that we are interested in is the treated post, which is the first variable here, and is negative and significant, suggesting that both margins have fallen since the pandemic. But what we can also observe in this table is that the two coefficients of the treatment variable and the post variable are significantly higher under the intensive margin. They seem to be a part of policy to shift focus or investment level to smaller size projects which are less risky. This table presents the estimation based on alternative measures of the treated group. The first one is based on the median value of the sovereign risk rating score. Countries rated below the median value of the ratings distribution that we discussed earlier are assigned 1, otherwise it's 0. This estimation is presented in column 1. Then the second measure is the 10-year government bond yield. Again, treated is assigned 1 if a country's average 10-year government bond yield is higher than the median value of the bond yields distribution. And the estimation is presented in column 2 for the bond yield. The treatment effect in both columns is negative and significant, which is consistent with the earlier findings that countries with higher sovereign risk has received lower investment from China. Now, here we wanted to check whether there's a direct relationship between sovereign risk and the quality of China's overseas infrastructure investment in the host country. So sovereign risk is the great number. So what we have done, we estimate a dependent variable, which is the ratio of troubled Chinese investment to total investment. Then we run a direct regression, but this is not a DID regression. So the estimated coefficients here, as you can see, sovereign risk ratings is negative signs, which suggest that lower sovereign risk ratings are associated with higher troubled investment ratio. So this helps to understand why host countries' sovereign risk is now important to China in terms of making infrastructure investment decisions. Okay, I think I managed the time. So to summarize our findings, we showed that countries with higher sovereign risk have received lower infrastructure investment from China since COVID-19 than countries with lower sovereign risk. Although investment level has fallen above the intensive and the extensive margin, but we've seen significantly larger reduction in the intensive margin, suggesting that China has reduced investment in larger projects than smaller ones. And our results also show that natural resources and geopolitical alignment between China and the host country mitigates these negative effects of sovereign risk on China's overseas infrastructure investment. In terms of policy, we encourage government to pay attention to their sovereign risk ratings if they are seeking investment from China. The findings highlight why policymakers should be aware of the impact of changing economic and market conditions since COVID-19 pandemic on overseas investment. Moreover, government can encourage more investment from China by developing strong ties and maintaining similar political views, especially during votings on key issues at the United Nations General Assembly. So that is the overview of our work so far. Thank you, and I hope to get some comments from you. Thank you.
Okay, thank you, Jeffrey. I would summarize it as a clear presentation, and you did control the speed of speaking, and you covered the background, the literature, and using some figures to illustrate, and also the models, etc. So I basically, I think you covered everything of the project so far. I do feel that for the audience, so we need to explain a little bit more about why we need to use DID, and that the main reason is obviously we want to check because there is a structural break of Chinese infrastructure, overseas infrastructure investment before and after COVID. So, and that's motivated us to use this DID econometric procedure. So I would like, I already received the email actually, and sending me the comments. I will forward it to you. So it's one of our previous PhDs from development studies, and maybe. So okay. So I'm going to forward it. She is not able to make it, but she has some useful comments. So I want to open the floor to the academics, the colleagues here. So I see if you have any comments, any additional thought about the content, and anything that is relevant, so we will consider. I do not see any hands now at the moment, but do we have any questions? Yeah, Tulu. Thank you, Tulu. Can you come in, please? Yeah.
Can you see me now?
Yeah, now I can see you, Tulu.
Yeah, I think this is going to be a minor comment, depending on Jeffrey's response. Can you go to the correlation matrix in the table for your correlation matrix?
Okay. Yeah.
Yeah, I see that the correlation between your main dependent variable, which is, the story you're talking about, sovereign risk,
Yes.
and OII,
yes.
OII,
Yes.
the correlation is 1.3%,
Yes.
which seems to me to be insignificant.
Okay, let me just put that down. Well, I think you're talking about the magnitude, but
the magnitude. Although you are not sure, you are not signaling whether it is significant or not, but given the magnitude, I want to assume that it is insignificant.
No, it is very significant. I think the
1.3% is not likely to be very significant.
No, it is significant, and we have not done a direct regression between these variables.
I know. This is your first result, okay? Univariate result. And it should signal, a relationship, a significant relation, because that's your story, okay? And it is what you develop on. And if at this fundamental level, there's an insignificant relationship between sovereign risk and OII, then whatever result, I'm coming, you have the opportunity to respond. Whatever results you build on this is questionable, okay? If you go back to your regression, I think that this is the reason why you did not pick up the issue of correlation. If you go to your regression, okay, you did not use this particular measure. You now went ahead to disaggregate the sovereign risk into high and low.
Okay.
You did not use the variable you measured in the correlation matrix.
Yes. Okay.
Okay.
So yeah, the thing is, in a DID settings, we are not regressing ORI on this. The sovereign risk. No, the reason that variable is there, the sovereign risk, is just to show the direction of the relationship. So what we are doing with that particular variable, we obtain that data so we can split the countries into the control and treated variable. So that variable, for example, that particular variable is what we have here, this treated. This treated is 1 if countries in that variable belong to the treated group. Then those are the ones that have been rated low by the rating agencies.
Then, that is what I'm saying. In your correlation matrix, okay?
Yeah.
The way you measure sovereign risk in your correlation matrix is different from the way you measured it in the regression. Okay? In the regression, you are distinguishing between high and low sovereign risk. In the correlation matrix, you are actually using the measure with 0 to 20. Okay? And that is why the correlation between your sovereign risk and OII is low, 1.3.
Okay, so what you're suggesting is that we should have used this dummy variable in the correlation matrix.
That is it. It should be so that it should tell a consistent story.
Okay, so you want
the variable you use in the regression should also be the one that comes up in the correlation matrix.
Okay, I get it. So the ratings should be removed. Then now I get what you're saying. Okay, yeah, we can do that easily. So we take this. Okay, we can also name that treated there. Okay, I got it. So thank you.
On the positive side,
yes,
I found your presentation very interesting and very smooth. And it is also theoretically motivated. Thank you very much for the presentation.
Oh, thank you for your comment.
Yeah.
Thank you.
Thanks, Tulu. As a second supervisor of Jeffrey's PhD, you only communicated those things here. I am surprised why he did not know how to present this correlation coefficient. But thank you very much. Just a joke. So correct. So I think we see the theoretical element, which I emphasized a lot. And we see that everything, went smoothly, and that's a significant improvement. So, any other comments in terms of the paper, the ideas, the execution of the paper? No, not too many. Yeah, Sulate, please. Yeah. Hello?
Okay, hello, good day.
Yeah, hi.
I hope we are all well.
Yeah, thank you. Yeah, hope you are well.
What the Tulu has just mentioned concerning the correlation, I will perhaps ask Jeffrey.
Yes.
What was the rationale of the correlation analysis? And how then does it inform your progression to regression analysis? Because if we don't have the reason for every statistics we present, you lose the followers, and the questions like what Tulu was asking will always emerge. So one mine is what was the necessity of the correlation, and how then does it inform your other statistics? Two, if I asked what is the theoretical basis, where do you hinge your study with the models I saw? What is the theoretical foundation under which this study is primarily anchored? Based on that theoretical basis, then you would see what contribution do you make to the theoretical existing theories. Because in studies of this nature, we don't only make summaries or managerial implication, but we also move forward to provide the theoretical contribution. If at all you had to indicate to us the theory, the primary theory you have anchored your study on, then you would see your contribution at the end, the very broad knowledge. Number three, I want to take me to your last slide of the summary of results, the summary. Okay, these are the summaries, and if I asked, what is your theoretical implication? It goes back to my earlier issue. Now, once the theoretical anchor is not developed very well, and perhaps critiqued so well, at the end, questions like what is your theoretical implication, as you can see, is lost. What I majorly see are to do with policy and managerial. And we can't afford to have a people of this nature without a theoretical implication and perhaps a methodological implication. Maybe you can shed more light on the two, the theoretical and then the methodological implications that might emanate or could have emanated from your study or any of this nature. I submit for now.
Thank you very much. I think those points are really, really helpful. First off, I need to acknowledge them, and then I will leave this to Jeffrey to respond to those questions. Jeffrey, how do you think?
Yes, the two main issues, the correlation matrix, how does that inform our work is, I think it's not different from the way correlation matrix normally, inform work. We need to see the direction of the relationship among the variables. We need to see the magnitude, for example, whether for example, when you look at the way we measure some variables, especially the institutional quality, there was one of the measures that we used before, which was the score as in percentage. There was this serious relationship. I think it was about 80-something% between that and infrastructure. So we changed that to the one between -2 to 0.2, which so the way that the correlation matrix inform our work is to understand that one, the data or the variables are related the way we expect them to be in univariate form than before the modeling side of the analysis, and also to know that our estimations have not suffered multicollinearity. So, and you also highlighted the things that Tolu mentioned, which is the variable that will be removed, then put in the other one. But for the theoretical side of the question, that does not seem very clear to me in terms of theoretical contribution, because we didn't really set out to make theoretical contribution. It's an empirical study, but we understand that we needed to develop our argument and hypothesis with strong theories, and that's why during the presentation I explained the reason that we consider what is going on in the environment since COVID-19, which is the general impairment to sovereign credit worthiness due to rising global debt level, and that are developed under the debt overhang theory, which simply suggests how that can connect to sovereign risk, which in turn affects investment incentives. Then the second theory that our study is based is the fact that, okay, even if the debt level is like this, the investors should be able to identify countries that have suffered significant impairments with higher sovereign risk. And this is information related issues. Then we discuss about information asymmetry, how that affects China's ability to make investment decisions to make sure that the countries that have not received investment or enough investment are simply because they actually have a high sovereign risk. So those are the two main, in addition to the general theory of FDI that I started within the literature, which is the ownership advantage, and that, but that is not really relevant to what we're doing. The main theory that drives what the changes that we've seen in China's investment, to connect it with the environment and over. These are the two main theories: the debt overhang theory and the information asymmetry. So I don't think we intend to make theoretical innovation, and I think if Professor Bo wants to contribute to this theoretical side, that would really be helpful.
Yeah, Jeffrey, I think the question on the contribution to the theory is not the breakthrough contribution. So what do we add in terms of this? So yes, I have seen all the results, but I have not read your theoretical part. So I need to work on that. But you need to think about, when you use some theories, what are the connections between those existing theories with the question that you are trying to work on, and then to think about why are they relevant or why are they not relevant. And I think that's something that we still need. I discussed something, but I need to think about those theoretical underlying theories more seriously. So, but the question also contained the implication for example, for managers of policy making. So can you elaborate a little bit more, rather than the theoretical contributions, but what are the empirical contributions?
Yeah, the empirical contributions for example, for policy makers is that like I said, we have to remember that China is an emerging economy, which means these policies tend to change over time. For example, before I think 2002 or so, Chinese investment policy was not driven by natural resources. It was merely market seeking, So, and evidence released that by one of the papers that ended up winning the Journal of International Business Award by Berkeley, that it wasn't, but the whole thing about natural resources started during that period, which is what we still have. So my point is that since COVID-19, we are seeing a policy shift, and that policy shift is this recognition of the sovereign risk that, okay, from the evidence that we have, China is now taking account of host nation sovereign risk. That means we have seen a change of the investment, the type of projects that China is investing in moving forward. We say that the size of average investment has reduced, which seems to be that China is focusing on smarter kind of investment, which means smaller and less risky. And this is important to host countries, including existing and potential government or policymakers who want to seek investment. You know that, okay, while you are looking at your factors in your country, for example, how your economy is doing and your sovereignty, you also need to look at what China is interested in. If China is your main investor, main foreign investor, you also have to pay attention to what China is investing in. And this is the result that we have provided, that is important for policymakers in the host country to identify this change. The host nation, the policymaker, need to pay attention to that, knowing that, okay, the factors, that is not just how we are doing, it's also what our key investor is interested in. And this is the direction of things. So that is my response. Thank you.
Mm-hmm. Okay, so I am sure it is clear there in terms of the policy implications. So and empirical contributions. So Raphael, I saw your hand. Thanks for your patience. And now I think I should give the floor to you, please. Yeah.
Thank you so much. How are you, Professor Bo? And Happy New Year.
I'm fine, thank you. Thank you.
Thank you.
Yeah, Happy New Year.
Thank you. Hi, Dr. Jeffrey. Very nice presentation.
Thank you.
Yeah, I hope you'll be able to share when it is published. The motivation is clear. I think the topic is important as well. Just a minor issue, perhaps I just want to learn.
Yeah.
If you go back to your model, yeah, just a slide with a model. Yeah, just here, yes. Yeah, so I've seen that, it's a two-way fixed effects model. So the time, then the country, host country, regional fixed effects.
Yes.
Now, normally when I in the software, because the variable of interest is interaction, so which is the treated and post.
Yes.
Now, when you run this regression the way it is, with again treated and then post in it, the software would delete the post and treated due to collinearity.
Yes.
And then in any case, I think what is important, the result we're looking for is on the interaction term. Yeah, I just wanted some clarity, because if you go to your first set of results,
yes,
I see that all the three are appearing in the regression. Thank you. Just that minor clarity.
Okay.
Thank you.
Yes. Thank you, Raphael. I understand what you're saying. I think I experienced that before during my PhD, but not in this case, not all the time. That is the thing. I think it depending on your data, Yes,
Okay.
I think it depends on the data and how the treated and post are defined. For example, if your treated is coded with longer longer ones, then when you interact it, then the multicollinearity is more likely to be higher, then you can draw. But in this case, no, we have all the variables.
Yeah, sure. Thank you so much.
Can I just, Rafael, can I just add one thing? So in the DID models, there are two types, two ways that you define this post-dummy. So if the post-dummy is the same for all the cross-section units, very often you need to take a treated and post together with the interaction term. Otherwise, if the post-dummy is different, for example, in this case, we have 110 countries, and the post is not COVID, is something related to the country. Then we have a so-called dynamic DID. In that case, we do not need the treated and post. I had a paper with another PhD, and we tried to look at the data, and indeed that is the case. If if you use the dynamic DID, then definitely you should not take a treated and post. So that's my experience, and we did have some references as well, and that paper is published.
Yes, I think you are very right, though, because the experience I had was with dynamic settings, because I had the lag of the dependent variable in my model. That was why it dropped, but not in this case. Yeah, thank you.
Yeah, thank you so much. That's useful. Thanks.
Thank you.
Thank you, Rafael.
Yeah.
And any other comments or observations or suggestions? Okay, and I think we are, in terms of the timing, so we are doing fine. And Jeffrey,
yes.
Do we have anything, or do I need just to close it?
No, I would like to say thank you to everyone who have managed to join us today, and the ones that have contributed. Every comment I received today will be considered, in fact, today. So I'll be working on all of them today. So thank you to everyone, to Tolu, to Sulai, to Rafael, and everyone. So yeah, thank you.
Okay, so thank you everybody for your support and for the contribution of the the comments, discussion, and yeah, I think we can close this session, and I hope you have the good rest of the week, and I will see you next week. Thank you.